If you've been getting denied by your lenders on your fix and flip or your development project, it might actually be because you're missing this one metric. And what if I told you by fixing this one metric, you could actually double your chances of getting funding? If we haven't already met yet, my name's John Newfer. I'm a private money lender, mentor, and trainer. So what is this lockjaw metric preventing lenders from funding your deal? Well, it's called loan to cost. And whether you're a seasoned investor or just getting started, understanding loan to cost, or LTC, is critical for securing financing for your next project and maximizing your returns. So what is loan to cost? Loan to cost is a financial metric used by lenders to determine the ratio of the loan amount or the total cost of the real estate project and how much they're comfortable with. So unlike loan to value, which compares the loan amount to the property's market value, loan to cost focuses on the total project cost, including the purchase price, renovation or construction costs, and any other expenses associated with bringing the project to completion. You see, the formula is simple. It all starts with the lender's guideline. You see, lenders have been doing this for a very long time. They know what maxes that they should go up to and what minimums they should have. You see, the lender's guideline is the starting point to loan to cost. So for example, a lender's saying, hey, the maximum amount of money that we're willing to extend on a project, the maximum amount cannot exceed normally 80 to 90% loan to cost. Now, there are other metrics involved, such as the ARV value and the LTV. But when it comes to loan to cost, this is normally where lenders stop the bar when it comes to development projects or fix and flips, about 80 to 90% loan to cost. So once we know the lender's guideline, then we can calculate how our project matches up with the max LTC the lender is offering. So let's get started. So now that we know what the lender guideline is, now we can calculate what our project is going to look like based on the guidelines. So let's just assume the lender guideline is 80% loan to cost. So the lender's saying, hey, I'm going to extend you credit. However, the maximum loan amount cannot exceed 80% loan to cost. Well, let's look at an example of how to calculate that. So what we're going to do is we're going to take our purchase price and we're going to add it to our rehab amount. So let's just say our purchase price is 300 grand. We're going to add $100,000 to that, which is our rehab cost, and that's going to give us a total cost of $400,000. Well, now all we do to determine the max loan amount that our lender is going to give us is we're going to multiply it by that 80% number. So we're going to go 400,000, which is the total project cost, multiplied by 0.8 or 80% in this case, and that's going to give us a total loan amount of $320,000 in this example. So what the lender is saying is the max loan amount cannot exceed 80% loan to cost, or $320,000 in this example. So why is LTC important? Why is it so critical for both lenders and borrowers? Well, for lenders, it provides a clear financial picture of the commitment that they're making relative to the total cost of the project. A lower LTC indicates a more conservative loan, and it reduces the lender's risk. For borrowers, a higher LTC means less money out of their pocket, allowing them to leverage their capital more efficiently. So let's look at a real world example. Let me give you an example to illustrate how LTC is used. So for example, one of my clients, an experienced real estate flipper, was eyeing a property listed at $300,000. The property needed significant work, so the estimated renovation cost was $150,000. Now the total project cost, therefore, is $450,000. Now the lender agreed to finance 85% of the project cost, which meant that they were offering a loan amount of $382,000. In this case, the LTC ratio of 85%, which is relatively high, and indicated that the lender had confidence in the borrower's ability to complete the project to completion. Now, my client only needed to bring $67,500 to the table, making it super easy for him to preserve his cash for other investments. So let's talk about how the lenders use LTC to evaluate the risk of a project and why is it actually that important to them. A higher LTC indicates that the lender is taking on more of the project's financial burden, which can be way riskier, especially if the project encounters delays or cost overruns. So the lenders often cap LTC at a certain percentage, typically between, like I said, 80 to 90%, depending on the borrower's experience. Now, from the investor's perspective, a higher LTC means they can finance a larger portion of the project with borrowed money. And that basically reduces their upfront costs and increases their potential for returns, that ROI, more cash on cash. However, it's important to balance this with the cost of borrowing, because a higher LTC often comes with higher interest rates and more fees to compensate for that increased risk from the lender's perspective. So in conclusion, guys, understanding LTC is essential for any real estate investor looking to leverage financing to grow their portfolio. And by knowing how much a lender's willing to finance relative to the total project cost, you can better plan your investments, manage your cash flow, and maximize your returns on your investment. So the next time you're negotiating a loan, make sure to consider LTC ratio. It could be the key to actually unlocking your deal if you're getting stuck at any point in the process. Well, guys, I hope you liked this video. Feel free to subscribe and hit the notification bell for more insights into lending metrics on the private money side. And if you haven't already done so, check out our membership community if you're looking to broker these loans and make a living off of private money and commercial mortgage notes. Thank you so much. I'll talk to you guys soon.